The next two panels will discuss the implications when EU taxonomy takes place in 2020, followed by how regulations can drive sustainable investing. Joe McHale, who heads up Bloomberg's European Government Relations and Regulatory Affairs, will be moderating both panels. So Joe, over to you.
Well, thank you, Hina. Good morning, ladies and gentlemen. And it's a real privilege to be here in Thailand for the first time, I may add. And we're going to be discussing the key issue of common ESG investing standards. And to help me with that task, we have a fantastic lineup of experts. So I'd now like to introduce on stage Anubhuti Gupta, who's the head of portfolio Management and Director of Asia at Rosenberg Equities, AXA Investment Managers. Then we'll have Alex Ng, who's the Chief Investment Officer, APAC, BNP Paribas. Then we have Anthony Fasso, who's the Chief Executive Officer, APAC, PineBridge Investments. Next, Krisada Sektrakul, who is the Senior Executive Vice President and the Head of Sustainable Development Division at the Stock Exchange of Thailand. Welcome. And next we have then Andrew Grijns, who's the Senior Portfolio Manager, Emerging Markets at Pictet Asset Management. And then last but certainly not least, Matthew Welch, who's the President of SASB. So thank you. And while we're just getting set up here on stage, let me just say if you could please have your polling apps ready, because we will try to use some live polling as we go through the discussion. I think we've already heard this morning essentially the issue of ESG almost in a nutshell. We've heard about the challenges of standards and the boundary and the pros and cons when they're voluntary versus when they're granular. We've certainly heard how ESG has become a board-level issue at this stage, and we've also heard some of the potential sort of downsides or risks that can arise in terms of the development of standards, i.e. if you have fragmentation across jurisdictions. So what I'd like to do is, as we go through the panel, I'd like to really get a sense of what's good, what is good when we talk about ESG investing standards, and what does that look like, and how can that be achieved? Now, to segue into that sort of more in-depth discussion, let me start off by, if I'll go from left to right across the panel of experts, and if I'll ask you very briefly to sort of introduce the perspective that you're coming to the debate from, and then also to give us your opinion on what you've heard this morning, and crucially on the issue of, is ESG adding and enhancing value tangibly, or is it something that's essentially almost like basic hygiene, something which is considered necessary to be doing business these days? So why don't we start with you, Anu?
Sure. So I'll talk about it from a very investment perspective. And the question, is ESG something we need to do because the market wants it, because people want to see that you are aligned with the ESG ideas? Or is it really adding value? So we have been doing a lot of research to really understand how this growing focus and recognition of ESG issues are impacting the investment potential of a company. So I'm going to talk from a public equities perspective. And one of the examples I would like to give is about climate change, the environmental dimension of ESG. That is one of the biggest issues where we have seen interest and alignment from investor and the general community. So what we have seen is, independent of everything else, a company's carbon footprint, its impact on climate change, is now starting to have a real impact on the valuation that investors accord to it. And we have done this analysis over time. So few years ago, we saw that it was a risk that was not really priced by the market, so to say, and we did not really see any impact from that. But as we move ahead in time, we are seeing that based on the average market prices, based on the market consensus, a company with a higher carbon footprint, all else being equal, will receive a lower valuation. So I would say definitely, just using this as an example, a very tangible example, ESG is actually adding value to investments.
Thank you. Alex, can we get your perspective on that? Do you see things differently, or does that chime with what you think is the general picture across the market?
Right. Yeah, I think when one talks about ESG, one frequently thinks of constraints and what one can't do. And I think that it's important to also highlight that it brings opportunities.
Yeah.
And that climate change breeds a new industry. It also brings in technology. So it's sometimes it's also not necessarily obvious that tech has an important component as well to play in ESG or climate change orientated portfolios. And so I think it's important to bring the opportunity aspect to the ESG debate and not necessarily just focus on the constraints and restraint aspect of ESG.
That's an excellent point. Anthony, what do you make of that?
I think having worked in this industry in Asia Pacific for 25, 30 years, I think what I've noticed is that, and learned a hard way over the years, is that investors in this region love guidelines, and the adoption of standards is very much embraced. And I think the great work that has come out of the EU with these guidelines and classifications, combined with the great work that's been done by also the Sustainability Accounting Standards Board, gives a lot more clarity and measurement and systematizes, I think, the approach to investment management. So I think, our clients want clear guidelines. The guidelines to us, we think are a first step and a very good first step. But we think a bit like, and I was talking to Joe earlier, a pre-briefing, these guidelines I think will be adapted over the years, a bit like we've had in investment management, investment banking, MiFID I, MiFID II. I think there'll be further iterations of this in the years ahead. So, but we certainly welcome it, and our clients and the investment consultants that we all deal with certainly welcome these guidelines as well.
Thank you. Krisada, coming to this from the exchange point of view, somewhat different, but nevertheless, is that familiar? Does that correlate also with what you're seeing and what you're hearing?
In terms of the exchange, I think the ESG standard is very important. It is one of our composites in our ESG development model. Let me share with you, in our Thai capital market, we develop in the supply side first, because we believe that the supply can create demand. We started the ESG issues, I think, after the crisis in 1997. At that time, we learned that the corporate governance should be very essential in rebuilding building up quality of our listed companies, and would help develop the longer term for the development of for sustainable development in our market. Throughout our ESG development journey, we promote the corporate sustainability and ESG integration into business strategies and operations among over 700 listed companies. I think I would like to share our model. The first one, I think we should have the ESG standard setting in the industry. In collaboration with the SEC and other stakeholders, we develop what we call CG principles, aligning with the OECD standard. And also, currently, there are more than 50 guidelines and manuals to offer practical tools for companies. The second composite is the ESG in practices. The Stock Exchange of Thailand provides companies with ongoing training and advisory programs on a variety of ESG topics. We promote and educate companies how to start and implement ESG in practices in process of their business throughout their value chains. The third composite is our industry should have the ESG disclosure standards. In our market, by the SEC regulation, there is a minimum standard that the listed companies must open the required ESG data in the company annual report. However, the Stock Exchange of Thailand also encourages and suggests a lot of companies to produce SD report or ESG report to disclose a more deeply ESG qualitative and quantitative data. The last one, the fourth composite, in our market, we encourage to have the ESG assessment and recognition. We conduct many assessment tools to help companies evaluate their ESG performance compared to their peers. For example, we have what we call the CGR or CG scorecard. We have the ESG stock list that we call Thailand Sustainability Investment or THSI Index. Also, we offer the award, the SET award to owner companies with outstanding sustainability practices. With our attempts for more than 20 years, we have a total of 20 Thai blue chips in Dow Jones Sustainability Index and 98 this year THSI stock list, which could be starting base for our investors, both domestic and foreign. For the demand side, I think we are still at an early stage. There are 23 ESG funds now with a total AUM $1 billion. But good news is that ESG momentum, I think we have a good momentum now. Thank you.
Excellent. Thank you, Krisada. Andrew, jumping back, I guess, to the asset management perspective, and I think it's come across quite clearly from the other colleagues here on the panel that there is a case that there are concrete and tangible enhancements to be seen. What's your view on that?
Well, we've certainly seen a big explosion in demand from investors for ESG type mandates, and clients that I've met with for 15 or 20 years for the very first time just this year are asking about ESG. These are government pension funds in Asia, sovereign wealth funds in the Middle East and so forth. So there is progress. The EU taxonomy is very, very welcome. In Europe, we have around a dozen different labels and classifications for strategies that meet ESG, and it's overly complex and difficult for investors to really make a comparison. So the EU taxonomy is very welcome. If it is interpreted too strictly, it may mean that there's too many assets chasing too few investments, such as green bonds, creating potentially asset bubbles. So it's not we think that the EU taxonomy is the starting point. We would like to see over time that it incorporates all E, S, and G issues, but we think that that will take many years because what is important to us for governance and social issues from a European perspective may be viewed very differently in other regions of the world, such as gender equality, LGBT equality, equal access to education, and so forth. But the way that we're doing it, and I think that we're doing something that's much more challenging, is that ESG is challenging just for public equities or corporate bonds. How do you apply it to investing in sovereign bonds, government bonds? And that's what we are doing now in emerging markets. I have seen a couple of funds from fairly well-known investment managers labeled as ESG or sustainable, but investing in some very questionable countries, if I may say, very large overweights to say Belarus, and so forth, or highly polluting economies such as Ecuador. And what we're doing is we don't want it to be just a tick box exercise and exclusions, because if you're not investing in bonds of a government, then you cannot have a two-way dialogue with them to try to make a difference. So what we want to do is look at a country may score poorly in terms of sustainability and environmental issues, but is it improving from a very low base? If it is, do we want to reward them and be investing there and engaging in a dialogue about what they're doing to improve those issues, but not just environment, but social issues and governance. And what we're doing now, which is different, is that investors like us used to do a country due diligence visit, and we would be escorted around in a minivan between the Marriott Hotel and the central bank and not really seeing what's happening on the ground. Now we're going to a township outside Johannesburg, low income, 55,000 people with no school. We're going to visit schools in Argentina, where the government have said that despite austerity measures as a requirement of the IMF bailout package, they said that they wouldn't be cutting the budget for education. So we went to go visit a school on the ground to see, is the government doing what they say they're doing? So there is kind of the EU taxonomy. Next is the S and the G. Part of it is tick box, but part of it is an engagement strategy as well.
Thanks, Andrew. You've mentioned the EU taxonomy, and it was also mentioned by some of the other colleagues as well, and that's a nice segue in to Matthew. But before, I guess, let me tee it up like this, Matthew. Even the name of the panel, we talk about it not being a panacea, essentially, to have common investment standards, because, of course, there are challenges and drawbacks as well, essentially, when you try to define common standards. You have the issue of unintended consequences, of one size fits all. If you have, for example, in the EU, where you have one jurisdiction pushing ahead very ambitiously, maybe you have fragmentation across sort of markets. And I want to get into some of those issues in a few minutes, but can you maybe bring it back to basics for us, in a sense, from the SASB perspective of, what in a sort of a first principles a type of way are the role of standards when we look at this issue?
Sure. Is this working?
Yes.
Good. All right. So I think the key elements to standards, of course, are that there's a standard measurement of data and that they are standard in use or in practice. And there are different ways to accomplish that, through regulation, for sure, but also through market movement, through the market voluntarily adopting the standard. And we are at early days of both of those things, emerging regulations and also emerging convergence on what are appropriate standards. Let me touch briefly on your very first question, which is about whether ESG practice and investment decision-making is good hygiene, or is it something that delivers value? And I think it's both. The standards that are out there today encompass a broad landscape, and you will see a lot of ESG disclosure by companies and ESG decision-making that is about a broader social mandate, and it has its place. But when we talk about investment decision-making and investment performance, that's something that goes to the heart of our mission at the Sustainability Accounting Standards Board. And the key things that we find there, through third-party research on our framework and looking at other frameworks, are two things matter. One, that standardization of the data, that you're comparing the same thing in the same way. As we heard on the previous panel, poor data is worse than no data at all. And the second thing is the concept of financial materiality. For investment decision making, if you can filter your data set to that which has some accepted rate of financial materiality, you do find that investment outperformance. We have 3 or 4 third-party studies that have shown investors seeking alpha, finding alpha, and reducing volatility in their portfolios when you apply a materiality-based framework over a standardized data set. So the opportunity is there.
Excellent. Now, let me come back to that question, and I'm going to pick on, I think, Anthony and Andrew in particular for this one, because you talked quite, supportively of the EU's taxonomy as it's emerging. And obviously, as we know, they are going for quite a granular approach. And can you share with us your views in terms of how that will potentially become a standard outside of Europe as well? And if you also see any risks with that as well, because Anthony, you made the comparison to MiFID, and you're right. I mean, MiFID, of course, in some respects, set some new global standards, but there were certain elements of it which, frankly, a lot of people in Europe were not happy with, and certainly, I think, some outside of Europe were not happy with it either. So where's the balance to be found, essentially?
I think the balance will be, in the dialogue you're having, the guidelines are great to have, the guidelines. And I think where we and probably many others in the industry see the opportunity is a detailed framework that you can have those conversations along those classifications and guidelines with the end company. So you've got a different way to engage with them now because you have a very clear and transparent set of questions, criteria, measurements. So I think it'll really change the dynamic when you're out doing your company visits or the AGMs or other stakeholders. You can have a lot different conversation and nudge them, I think, in the direction that they need to adopt these standards, because as we've seen in referencing your comments about MiFID or GDPR on global data privacy, the EU is leading it. Great, fantastic. And I think this will become the gold standard. And as we saw with MiFID, that has implications right across the world. So people are adopting that standard in many other countries because most companies are global. So you have to have the best standard, and that's the one for MiFID type conduct. And I think the same will happen with this new taxonomy guidelines. It'll become the standard, and then it'll be a conversation around adapting it into portfolios. But I think, as I said earlier, the conversation you can now have with corporates, you've got a clear set of guidelines, and I think that will change the discussion.
Excellent. Well, can you maybe elaborate a little bit further, Andrew, on what does good look like in terms of sort of standards as well? What do you think, what principles need to be there as the EU continues sort of finalizing its taxonomy and then rolling it out for you to say, okay, this is good, this is useful, this is going to actually support the further development of the market. And on balance, it has, gotten it right and avoided some of the unintended consequences.
I think it's a very good starting point, but it doesn't mean that asset managers have to completely abide by this taxonomy. They can apply their own criteria, which I think is the right thing to do. But again, we need to start somewhere. But, for an asset manager like us, we want to go, a few more levels beyond that. We do think that this should, over time, incorporate the UN development goals and be in line with that. But it does allow investors to sort of benchmark or check, how sustainable an investment strategy or asset manager is, and should set the tone for how it's put in place in other countries or regions of the world. But I think we should avoid telling other countries or regions that this is the best way, as wealthy Europeans, flying in as some sort of new form of imperialism. So I think that this will be evolving over time.
Well, that's exactly the point, right? And that brings me on to my next question then. Actually, what can Europe learn then from Asia and indeed the US or indeed any other jurisdiction? So maybe, Anu, can we get your sort of perspective? And I'd like to bring Alex and Krisada into this discussion as well. How can Asia, and can Asia lead, and how can they lead on ESG investing standards?
Yeah, absolutely. One example is China. It is already the world's largest green bond issuer. So clearly, like what we are seeing is there's a lot of interest from the asset allocators, investor in Asia, but the challenges are there's a lot of confusion around it.
Right.
So if we can have a framework which is universally understood, broad enough, but at the same time incorporating the local nuances, that will bring everyone along. So the real challenge is, can we cut through the confusion and give investors something simple, but at the same time, that is reflective of the challenges that they are facing. So for Asia, here the impact per dollar of investment, that potential, that opportunity is huge. And we are seeing that companies, consumers, clients, governments, they're all moving in the same direction. So the critical mass, the momentum is really there. It's just about making sure that the Asian context is incorporated into whatever standard framework that we are building,
right,
and that we eventually want the world to evolve towards.
Excellent. Alex, you at the beginning mentioned opportunities. Yes. So what are they?
Right. I think we've progressed from interest on ESG to how we'll do it, and interest in green issues, to now questioning whether there's greenwashing.
Right.
I think what EU taxonomy will bring is to provide confidence to investors that if they're investing in green, it is green. And what is the definition of green? So I think it's important to therefore understand EU taxonomy in the context that we go from principles-based to science-based, that we go to activity-based measurements, and that we want to adopt, ideally around the world, a common metric. So when we measure power, it's all based on grams of CO2 per kilowatt hour. Not kilojoules, but kilowatt hour, for example. So we all speak a common metric standard around the world. But the thresholds can be different. So, and the EU taxonomy is based, if you like, on, if we take the power sector, for example, of going to zero carbon in 2050. Now, so I think we want to also understand our taxonomy and our thresholds based on what our end targets are. So in ASEAN's case, for example, it's not zero carbon for power sector. It's still net positive. Mm-hmm. So it doesn't need to have the same thresholds that the EU has.
Right.
But that being said, though, I do think that it is also very confusing to a global investor if each country has an individual threshold. So if you'd like, I've been encouraging regulators to think of groupings of countries so that you may have a level 1 taxonomy. Right. If you want to appeal to a global investor that's sort of green-minded. But you could also have a developed, emerging, and in ASEAN's case, you could also use the IEA ASEAN targets as the threshold rather than necessarily an international investor having to sieve through individual country thresholds. So that's, so one aspect of a good standard is not to have too many standards, but to be also conscious that certain regions will have their peculiar requirements.
Absolutely.
Yeah.
I saw, just before I bring you in, on the Thai and Asian perspective, Krisada, I saw you shaking your head in agreement. Obviously, at the talk about standards, Matthew, and obviously you're probably, I would say, that one of the best placed here in the room, coming from the SASB perspective. But what do you think when you hear about, you know, some of the suggestions around grouping, for example, and you know, how you can avoid sort of trying to apply a one-size-fits-all?
It's an important question, and I was nodding because what you were saying resonates so much with me. I think that principle of having a common framework that operates anywhere is important. If it doesn't, we fail to create a standard. But I think that local tailoring, which both of you discussed, different thresholds for different regions given different considerations is incredibly important. And it resonates for me because SASB begun with a focus on the US markets and has since turned outward, largely because investors clearly invest globally and not just in the US. And we've needed to adapt and operate. And that has required us to engage in all markets and understand how can we take the core principles, which the broad set of global participants agrees upon, but tailor them for specific local needs so that the standard operates.
Great, thank you. And Krisada, if we jump back to the point on how can Asia lead, how can Thailand lead, how can stock exchanges lead?
I cannot say that. As the exchange, I think because we are in the emerging market, so I think we have a lot of room for improvement, especially for our mid-small cap companies. From your question, I do not think that we are competing to lead, but I think we have to collaborate. Right. Since investment opportunities could happen anywhere in the world, so you can see, that even in the Southeast Asia, you can find some good ESG stocks. So, but I think that when you issue the Europe taxonomy, I think we could learn from you. Even we can learn from other regions also for the standard. So I think mostly we can find out the common standard like a ESG metric, something like that. And also not only the standard from other region, we have to look at the that the ESG problem in our country, in each country also. So that the doing business should answer the question about the ESG issue in domestic market also. Thank you.
Excellent. Let me go to the polling question now at this stage, because I think we're running short of time, but I want to bring the audience in, and then we'll get a chance for all of the experts on the panel to quickly respond to the results. So the live polling question should be appearing now, and essentially the question is, which ESG investing strategies do you currently use? And you can select all that apply. Screening, positive, negative, exclusionary, corporate engagement or shareholder action, impact investing, investments made with the intention to generate a measurable, beneficial, social or environmental impact, sustainability themed investing, example, clean energy, green technology, sustainable agriculture, and ESG integration, systematic inclusion of ESG factors into financial analysis. So the numbers are bouncing around quite a bit, but I guess it's not a massive surprise that all of them have quite a decent showing, with the leader though being screening, i.e. positive, negative or exclusionary, followed closely by corporate engagement, shareholder action, or ESG integration into financial analysis. So, as I say, they're bouncing around, but I think we can more or less see the general theme. Now, we don't have a lot of time left, but I'd like to get your reaction on when you see results like this. Quick fire round. What does that make you think, Anu?
Yeah, I don't think it is so surprising because exclusion still dominates.
Yeah.
Reason being it is simple to do, easy to understand, but it's probably not sufficient in itself. The other is ESG integration. Increasingly, research is becoming available that shows that by incorporating ESG, you can move away from things like short-termism. You can actually reduce risk and also capture opportunities. So there is not just a risk dimension, but also a return dimension to it. So that's also not surprising to me. And as more and more data sources, more information, more disclosures are happening, are becoming available, it is actually possible for asset managers, investors to systematically start integrating these ideas into their investments.
Excellent.
So, I mean, I would say it's not entirely, it makes sense, these results.
Alex, makes sense?
Yeah, in fact, what surprises me is how reasonably well spread it is, although exclusion and screening leads, but how highly ranked some of the other categories are. We do all of them, so it's good to see that there is traction across. But I want to take this opportunity to just quickly say that when we ask the question, will Asia lead? It sounds very far-fetched, but I don't think we should be discouraged as well, because since we're in Thailand, I think it's worth highlighting that in the Sustainable Stock Exchange ranking, other than 6 continental European exchanges, Thailand ranks #1 in the world, outranking all the other global stock exchanges that we normally think as leading stock exchanges. So, and when it comes to social, 7 of the top 10 gender equality countries are in Asia Pacific. So, and I think Anubhuti has also mentioned about China's drive into the environment, where it's probably outspending any other country in the world in terms of the environment. So I do think that while it seems like kind of a far-fetched goal, but we shouldn't be discouraged that there are areas where Asia is really moving ahead and that we should continue to do more.
So it's already leading. Anthony.
I'm very pleased with the ESG integration. I hadn't expected to be, I was hoping it might be high, but it's probably higher than I expected, so I'm very pleased with that.
Excellent. Krisada, any views on?
Thank you for naming the Stock Exchange of Thailand. I think, luckily, I think maybe we have something different from other exchange because we have, in our organization chart, we have some many divisions that help the industry to like education development or even the ESG development for the stakeholders. And so I think we are lucky to help the industry like that.
Excellent.
Thank you.
Andrew, any final comments?
I'm glad to see that engagement scores fairly highly, and we would encourage investors to do more engagement and dialogue with issuers, especially in bonds, not just corporate bonds, but sovereign bonds, and have in the prospectuses ESG issues, what a sovereign, quasi-sovereign, or corporate is doing about those issues. So we would like to see more engagement and dialogue.
And finally, Matthew.
Sure, just briefly, I think screening is a natural starting point and ESG integration is a natural ending point and the end goal. Once we are incorporating ESG into all investment decisions, we will have accomplished what I think we're setting out to do.
Excellent. Well, I think we've run out of time. We could probably actually talk all day on this particular issue, but you've set the discussion up as well very nicely for the next panel. I'm staying on for that. But thank you once again, and ladies and gentlemen, please give our experts a round of applause. Thank you. So, while we're getting set up for the next panel, allow me just to say, similarly, we're going to try to use some live polling, and I think you'll agree it adds some real value to the discussion. It allows us to see, are we talking about the right things, essentially. So as I said, that panel really teed up our next discussion very well, because we're really going to get down into the details now. We're going to discuss in further depth the ESG Regulatory Framework. And similarly to the last panel, I'm joined by a group of experts, and I'd like to now welcome on stage Tan Boon Jin, who's the CEO of SGX Singapore. So welcome, Tan. Matthew McAdam, who's the Director, Asia Pacific for the Principles for Responsible Investment, Australia. Dr. Anthony Miller, who's the coordinator of the Sustainable Stock Exchanges Initiative at the UN in Switzerland. Janine Stamp, who's the founder of the Asia Sustainable Finance Initiative, and the head of Asia Sustainable Finance Global Finance Practice at WWF Singapore, and Ms. Paralee Sukontaman, who's the Deputy Secretary General of the Securities and Exchange Commission of Thailand. So, welcome everybody to the panel. So I feel like the last panel, in one respect, almost sort of covered some of the ground that we were going to touch on. But actually, I think it just allows us to get into an even greater level of depth and to further drill down into some of the details about the ESG regulatory framework. So we had that interesting discussion about should Asia follow the path of Europe, or is that a case of one size doesn't fit all? So I'd like to, as the panelists introduce themselves and explain how they're coming to the ESG debate, if they could give their perspective as well on how they assess the current ESG regulatory framework. And let's start by going from left to right. So if we can start with Tan Boon Jin, please.
All right. I'm going to give my perspective as a regulator. So I would like to start with the origin story of ESG. So ESG first appeared in a UN study entitled "Who Cares Wins." So it's not just about doing the right thing. It's about winning. It's about winning. So the promise is that if you're a company that cares about ESG, your performance will be better. And if you're an investor that invests in a company that cares about ESG, you will get better returns. So to me, as a regulator, a good ESG regulatory framework will have to achieve three things. The first is data to show the link between caring about ESG and superior performance. The second is companies producing data to demonstrate this. And finally, investors consuming data to validate this.
Excellent. Please.
So I guess my opening observation as the PRI is that there are more policymakers, I think, in the right places, in more markets around the world that are on the same wavelength as investors now when it comes to sustainability. And there's absolutely no backtracking from that. So at the PRI, we've been tracking policy developments now for a number of years, and there are over 730 pieces of legislation, regulation legislation around the world that now encourage or require investors and companies to think about ESG issues. And something like 80 of those, or over 10%, have been introduced just in the last 12 months, which is astonishing. So there's sort of a Moore's law almost happening now for sustainable finance and policy, which, as I said, there's no going back from.
Excellent. Anthony, can we get your perspective, please?
Yes, sure. Last year we published a report on how securities regulators can promote the SDGs. And one of the things we always do is we just focus on what people are already doing. We try to avoid what I call blue sky ideas where we think, gee, wouldn't it be nice if ... Rather, we say, what are they actually doing in the marketplace? And what we found is quite a lot. There's quite a lot going on already. Certainly more can be done. But a lot of securities regulators are already engaged in, and I'm sure we'll hear more about that, on ESG issues in their marketplace. And there's a wide spectrum of what they can do. Because typically we always just think about passing rules around disclosure. Yes, that's an obvious one and it's an important one. But there are a lot of other things they can do around product development, market education, and so on. So I think that's a key thing to watch. There's a theme that I think I've noticed pop up in a number of the questions, previous panel, this panel, about what maybe Asia can learn from Europe or what have you. I think really, to some extent, the question should be reversed. What can Europe learn from Asia, and what can developed markets learn from emerging markets? We launched the Sustainable Stock Exchanges initiative 10 years ago, It wasn't launched as the Emerging Markets Sustainable Stock Exchange Initiative or the Developed Markets. And at the time that we launched it, many people expected, we'd get very slow take-up in emerging markets. And the opposite has been true. We've had very strong take-up. Thai Stock Exchange has been one of our more active members. They do a lot of excellent work in this space. And I think that there's a lot of developed markets that could perhaps learn a lot more from what's going on in emerging markets, both from the regulators and the exchanges.
Absolutely, excellent point. Janine, can we get your perspective?
Yeah, sure. I think there's a very wide range in terms of the regulatory frameworks out there now. If we look at the three key pillars of what a good regulatory framework should contain, if you look at the first one in terms of taxonomy, you see that it's only the EU and China that today have some form of a taxonomy, but that's only limited to the green side, and other countries don't have that. The second pillar, we look at scenario analysis. So again, you have certain regulators proposing to conduct stress tests and scenario analysis across their financial system. So if you look at Bank of England, doing that across a series of climate pathways, including net zero by 2050, and then you see that other regulators are at this point silent on scenario analysis. And the third is, of course, disclosure, where you have multiple stock exchanges and regulators asking for disclosure, but leaving it up to the companies to decide what is material. Right? And then you have, on the other side of the spectrum, you have the UK and EU already signaling that they want to make TCFD mandatory. You have the French, which has already gone ahead in terms of Article 173, that all financial institutions have to disclose how they manage climate risk. And just recently, in September this year, that was amended to also include how financial institutions manage biodiversity risk. And that was on the back of a report that the French Ministry for Ecological Transition commissioned AXA and WWF to write, and it was presented to the G7 Ministers of Environment meeting in May. So you see, that's one end where it's compulsory for everyone to disclose and to convince the market that this is not a risk for me, or this is a risk and this is how I'm managing it, to the other end, which is we'll let the companies, and same thing for the taxonomy. One can describe what is green, using one's own subjective calibration, or there is the taxonomy.
Absolutely.
And, yeah.
Ms. Paralee, can you give us the perspective of Thailand? How is it coming to the discussion? And then how has the SEC here approached the regulation of ESG so far?
Yes. As to the regulator, our main objective is to create, the confidence and trust in the market, and also the integrity of the capital market. So in order to the success of creating a strong ESG development in the Thai capital market are linked to the three mechanisms that the SEC followed: regulation, self, and market. Above all, it is the commitment and involvement of the SEC and other relevant agencies that have played a role in the development of the ESG in the capital market. Through various measures with the emphasis of self and market initiatives, the SEC has adopted regulations, and it also remains important. For example, the rules and regulations and guidelines that the SEC has been issued, and also the preventive measures, disclosure and risk monitoring system, and enforcement that the SEC has been, undertaken all along. The self-discipline, concentrates on company and its board of directors. So in this regard, the SEC requests the board of directors to integrate ESG into their business operations and create sustainable value creation. A new CG code, for example, of listed companies later expanded to ESG was issued in 2017 to be used as a guideline for self-disciplined business practice and activities. In this regard, board of directors are expected to take leadership role in setting goals and leading towards sustainable growth organizations. Lastly, market force discipline, which is the third. This, on the other hand, focuses on encourage more on external push towards the ESG development of listed companies, i.e. forces of investors, in particular institutional investors.
Excellent. Well, it sounds like quite a lot has been done already, and I mean that's clear as well from the discussion about what's happening in other jurisdictions. But Boonjin, quite a lot is happening, but is it enough? Should there be more? Are we focusing on the right things? Where should we be focusing?
Okay, I would like to draw a very important distinction here, all right? So you have the regulatory frameworks which are mandatory, right? And then you have the reporting frameworks which are voluntary. So I think it's very important to recognize this distinction. So if you look at what the regulatory frameworks are focusing on, they are focusing on mandating ESG reporting by companies.
Right.
So there is less emphasis on reporting by investors, and also they are less prescriptive in terms of the reporting format. So this results in a few things. Number one, instead of metrics, you will see more activities being reported by companies. So that's the first thing. Secondly, the link between ESG and performance is less clear. And finally, in terms of the data produced, it is also not easily comparable. So these are the three manifestations, right? Compare this, though, with the voluntary reporting frameworks. If you look at them, they are more prescriptive in terms of the format. So the data is more harmonized, it's more comparable, and this is especially true for those that are industry-specific. I think the industry-specific voluntary frameworks do an excellent job in terms of being able to demonstrate the impact of ESG on performance. And if you look at other voluntary frameworks like the TCFD, it doesn't just focus on companies, but it also focuses on investors and how investors should be incorporating ESG into their decision making. So I think the next step for us is how to bridge this gap between the regulatory framework and the reporting frameworks. And someone mentioned earlier from the other panel that Asia likes guidelines. And I think that in Asia, the only way to do this is by expanding the regulatory framework.
Excellent. Well, let me jump over back to Janine, because one of the things that came up when we were discussing earlier was around this issue of mandatory disclosure. And do you think that mandatory disclosure requirements like TCFD and that Boonjin mentioned actually provide the solution? Do you think that is the way to go, this mandatory sort of approach? Because it's still voluntary, but in Europe now TCFD has been integrated into the non-reporting financial directive for the climate-related guidelines. So it's non-binding, but you can see it is the sort of the thin end of the wedge. Essentially, it is certainly heading in one clear direction.
I mean, disclosure is key for efficient capital markets, right? So, but what is more important is what is being disclosed, right? So you can force everyone to disclose what they're doing about climate and the results of the scenario analysis, their strategy, their targets, right? But we need to have some guiding principles. I mean, Dr. Siri mentioned this morning, there is no planet B, right? And Alex in the previous panel talked about science. So if the companies are provided with a library, and NGFS is talking about doing that, and potentially with TCFD as well, a library of common scenarios for each sector, then the information that is being disclosed then becomes A, consistent, B, comparable, and decision useful for the market, as opposed to everyone creating their own scenario and disclosing what their targets are without the market understanding how do these targets look in light of where the world needs to get to, right? So different companies can have a different level of ambition, but the context needs to be there, and that context is science, right? Because we can't have one version of green in one market, another version of green in another market. We can have slower pace, right, and a lighter shade of green, but we can't have two different versions of light green as such. They're just confused, because then you come out, anything that you disclose just becomes completely incomparable, even within a country, let alone across borders.
But isn't that the, and I'd like to get Anthony's and Matthew's perspective on this as well. Isn't that potentially, though, the risk that you will end up with different shades of green in different jurisdictions? Because even if you take something like TCFD, which is global, as soon as jurisdictions start sort of hardwiring it into their own frameworks and making adjustments, etc., do you run the risk of having then fragmentation across markets? Because in some respects, the EU Commission just recently launched as well its sustainable finance, an international forum on sustainable finance. And of course, in some respects, it is very much to ensure that its regulatory approach is sort of exported to the rest of the world. So how do we avoid, though, that fragmentation across markets?
Joe, I think, if you're asking me how do we avoid being imperfect, I think the answer to that is we don't.
How do we manage it then?
We manage it the same way we manage it everywhere else. We've been having a conversation about financial reporting for about 100 years now.
Right.
And we still live in a world where if you have 10 accountants in a room, you're going to have 11 different opinions. Now you have IASB and international IFRS, and yet when countries implement IFRS, they often will make very small little carve-outs here and there, so there can be little things. Yet somehow, the global financial system adjusts to it and works with it. So I think we need to also be a little bit careful about being too hard on emerging ESG standards and regulations and putting a burden on them or raising the bar far higher than we would ever do for financial reporting.
Right.
There might be local variations on some of these things. I think investors will read through those the same way they do for financial reporting.
Excellent.
There's nothing wrong with different shades of green. You actually need different shades of green because not everyone or every company in the world today is going to have operating activities that meet the EU taxonomy, for example. And the whole idea is to actually build out the different shades of green all the way through to the brown. I mean, Mark Carney just talked about that at the UN Climate Summit. And different countries and different companies will be at different parts along the spectrum, but we're all using that same color chart. So what you say to be light green in the US is the same as light green in Thailand, but a company here may be, darker green or darker brown. Same thing with another company in the US, but we're using the same calibration system.
Okay.
Yeah.
You're dying to get in on that point.
I think it's very important here to recognize that when we talk about fragmentation in ESG, right, it's not talking about fragmentation in the balkanization sense, meaning that we're not talking about domestic regulators raising barriers because they are afraid about importing harmful risk, which is what we're seeing in the swap markets. So this is not about MiFID II versus Dodd-Frank, right? In fact, I would agree with you. The analogy I would draw would be US GAAP versus IFRS, and so I do think that is there is a greater chance of convergence.
Yeah, I just support everyone else's points that this is about transparency and disclosure, and that's a first step. I think obviously countries around the world have very different ways of meeting their commitments under the Paris Agreement, and investors are used to operating locally and operating regionally, and certainly the progressive leading investors in Europe on these types of topics will be supportive of the development of local taxonomy which recognize those differences.
Excellent. Well, I'd like to bring in the audience now at this stage. So if we could go to the live polling, and it should be appearing on your screen.
Can I add something?
Please, Ms. Parallel.
For us, we we support the taxonomy. We follow the movement pretty closely, but as to regulator, when we before we issue any regulation, we have to analyze the ecosystem of Thailand. We have to analyze also the cost benefit of our regulation, and also we have to listen to our stakeholders to see if the cost has the benefit has outweighed the cost before we issue any regulation. So let's see if the outcome will be.
Absolutely, absolutely valid point on the cost benefit, and and the importance as well linked to that is any of these measures being grounded and essentially being based on, it was mentioned earlier, the science and the data. Thank you. So let's now launch the live polling question, and it's on your screen now, and the question is, can regulations advance adoption of ESG in APAC? And I'm not really surprised. It'll bounce around a little bit and stabilize, but I think it's quite clear that it's overwhelming that the feeling is that yes, it can, which I then guess brings us to the question of, okay, how and what next? What should be the sort of the future priorities? If you were sitting here as a regulator, and you are sitting here as a regulator, what should we be focusing on next? As the sort of as we think about the next, where would you like to see us in a year, 5 years? Where do we need to be in 10 years, essentially? So if we start off again with you, Jim Boon.
Let me just share what we're doing here in Singapore. We mandated sustainability reporting just last year. So this year, we're going to collect the first wave of reports. And what we're going to do is we're going to do a review of all the reports. And we are going to engage investors as well to help us in reviewing all these reports. And then we are going to issue to every single company a scorecard. Okay. All right, with investors' input as to how they did to help them to improve. Now, somebody actually commented that, oh, is this a little bit of a babysitting, right? And my response to that is yes, but I think we need to be very cognizant that there is a factor here that should not be underestimated, which is time. So I think we need to do what we need to do.
But that's interesting. Who responds like that? And who potentially pushes back against that approach?
You have no idea.
I probably do.
Well, I don't expect this to be an easy conversation, but I do feel that there is an imperative. And what really heartens me is that there's global leadership, and recently as well, I feel that it's growing national leadership.
Excellent. Matthew?
Yeah, so let's be honest, organizations like the PRI only exist because there isn't global policy frameworks to require investors to think about ESG integration and disclosure. So our ambition is obviously to put ourselves out of a job in the next decade, but I think somehow it's going to be a lot longer than that. I think our priority at the PRI is climate action. There's a massive gap between the rhetoric and the action on the investor side. We obviously have the biggest market failure in climate change insofar as governments have committed to the Paris Agreement and 2-degree target, but we have investors and companies that are still operating as if we're on track for a 3, 4, and 5-degree world. And I think it's global initiatives like the G20 study group on sustainable finance and the NGEFS and action by a lot of prudential regulators to look at scenarios and stress tests and to standardize those around the world, which will help to close that gap, because once it ends up on the balance sheets and the P&L statements of companies, then it has the attention of the portfolio managers and the CIOs.
Anthony, where would you focus the firepower?
Yeah, I think what you're seeing now is a global trend of regulators coming in and making mandatory ESG disclosure. We're up to about 26 markets in the world now where it is mandatory. And that number less than 10 years ago would have been less than 5. So it's a very fast, rapid uphill climb in that space. So that's clearly an area for security market regulators. I think the example we just heard from Singapore is a very good example of illustrating things you can go beyond just simply saying this is mandatory and then walk away. You can't do that. And securities regulators, they play a number of other functions in the marketplace, including providing education to market participants and feedback and so on. So I think this is a very good example of kind of the soft power of securities regulators to get involved in the marketplace. One thing that I think is missing from this conversation a little bit is we talk a lot about the work of securities regulators because we're working, we're talking in a sustainable finance context, but we also have to be in mind when we talk about regulation of the real economy and the impact that will have on the world of finance and investors.
Excellent. Janine, can we get your perspective?
Yeah, I'd just like to say that, with the Network for Greening the Financial System, you have very good Asian representation. You've got China, you've got Japan, you've got Singapore, Malaysia, Thailand, and another 2 waiting in the wings. And I think that will really help to bring some form of harmonization globally, and also help to empower the Asian regulators to perhaps take a step further. And, the NGFS is not just banking regulators, it's also the insurance regulators, on the investment side, so it's supervisors and central banks. So I think those are other parts of the market that do affect, the ability for any listed company to get bank financing, to get insurance. Those are things that an investor also needs to think about, and those parts of the regulatory system are moving actually faster. Yeah. Right? So, EU, of course, on the investor side has mandated disclosure by investors of the E&S impacts of their financial portfolios, as well as the financial risks from E&S issues. Yeah. But that is quite rare from that point of view. Otherwise, the regulations have been more banking and insurance industry heavy from that point of view. And I think that's also where there needs to be a better dialogue because of course, the interlinkages, and the insurers themselves are also investors.
Excellent. And Parley, what future measures can the audience and can we expect here in Thailand from the SEC?
We're planning to take about six initiatives. First, we planning to increase number of ESG funds. In this, we are planning to do that through the two associations. First is the associations of fund management, asset management association. The second is the Ministry of Manpower, which is the government. And because we find that currently there's only 11 funds that CG funds, and that only have 26 billion baht. Number two initiatives, we're going to increase innovation, sustainability, theme, capital market products and instruments. For example, CG funds, green bonds, social bonds, sustainability bonds. By doing that, we have already rules in place, but we're doing more, amend rules, and also we can do fee exemptions, for example. Number three, we find that our listed companies have better CG performance, but more significant performance remain large companies. So we trying to work on small and medium cap companies. So we trying to do like tutoring session. We kind to, through our partners, for example, IOD, Stock Exchange of Thailand. We're trying to work on those smaller firm size and trying to talk to them that how to prepare for the assessment program. 4, we're trying to strengthen market force development by institutional investors. By doing this, we have 3, sub-plans. We support GPF, SSO to set criteria for choosing fund management companies based on the level of compliance with the I code. And also, we establish a core platform for coordinating and networking with major institutional investors to get feedback, from them. And we also want to increase PVD signatory. Number 5, we want to promote the implementation of the globally recognized principle of human rights protection, UNGPs, because in the middle of the year we have signed MOUs with the National Human Rights Commission in May 2019. And we want to embark, this also in the ESG issue. Lastly, initiatives number 6, we want to be serious on the implementation side. So we considering, working together with some institution to analyze, and also rating, like tick box and also dialogues with firms of all sizes, trying to rate, really rate the implementation of all those firms.
Excellent.
Yeah,
Well,
that's all what
sounds
we're
like you
going
have
to do.
a
lot
full
to do.
work program. Exactly. We should probably plan to come back here in the very near future to see how that's going. A final question, just before I think we head into the coffee break. It struck me that it came up a number of times. We talked about security regulators, and actually we need to speak about prudential regulators and central banks as well. But actually it's broader than that as well, right? So is there enough actual coordination, going on even between securities regulators and central banks, but then widen that to civic society, NGOs? What about the unlisted sector as well? Sort of in the minute or two we have left, does anybody want to jump in there and give their perspective on sort of the need for actually wider coordination on this, and actually potentially across political collaboration as well, in terms of, if it's possible, depoliticizing the issue and everyone agreeing that, this is science, this is facts, and actually, we're all working towards the same goal. Anybody want to jump in on that?
I would just jump in on one thing, which is the source of regulation, again, going beyond securities regulators. It's not only other central government regulators, you're even looking at municipal regulators. So, for example, in New York City, they passed much more stringent rules around the efficiency of buildings. Now, for any investors that hold large portfolios of real estate, there's going to be a one-to-one correlation between, retrofitting a building to make it more efficient, and all that money that's going into insulation is not going into dividends now. So this is something where I think for investors, certainly, they have to keep a broader perspective on the source of regulation, but also for securities market regulators, when they start thinking about systemic issues in the marketplace, which is part of their core mandate, they have to be aware about how climate can become a systemic issue throughout broad areas of the financial markets.
Excellent. Any final word on that?
For us, in Thailand, we have this national plans, for Thailand. Which will last about 20 years, and also the government direction, just released their direction, earlier this year, and that would include, CG, ESG, and all these 17 UN, SDGs, so it relates, all these. The SEC also embed its plan, following these principles.
Absolutely. Well, I think we've run out of time, so I believe we're now heading into a coffee break. So, ladies and gentlemen, please join me in a round of applause for our distinguished panel of experts.
Thank you to all of our panelists. Joe, thank you very much. We're going to let you stretch your legs for the next 10 minutes or so, grab a coffee, some refreshments, and if we can be back in the room for around 11:30 so that we can stay on track and ensure that you get the best out of the day. Thank you very much. We'll see you shortly.